Hey, this is Justin with DayTradeTheMarkets.com, and in this video I want to explain, kind of in layman's terms, the idea of aggression when it comes to trading and why understanding which side is more aggressive is so important to your trading, and how you can use that concept and the concept that we call relative aggression to make better sense of the market in real time so that you can make better decisions and get yourself into more high expectancy trades and then keep yourself out of more lower expectancy trades. And before we get to that though, I want to talk about kind of a misconception that a lot of people have. You may have heard this. People tend to think that the market goes up because there's more buyers than sellers, or that the market goes down because there's more sellers than buyers. And certainly in a way that seems to make sense, but it's not really accurate. By definition, there's both a buyer and a seller for every transaction that happens. And the only way that the market moves higher or lower is when either buyers or sellers are more aggressive. So in other words, the market moves higher when buyers are more aggressive, and the market moves lower when sellers are more aggressive. That's really all there is to it. And so I wanted to kind of give an example in layman's terms by just talking about a buyer and seller negotiating the sale of a car. And so just for this example, let's just say that you want to buy a car, you find the car you want, it's being sold by someone named Bob, and let's say that he's selling it for $20,000, but that you only want to pay $19,000, okay? And for the sake of this example, let's just assume you can't negotiate to $19,500. In other words, that the car can only be sold at $19,000 or at $20,000, okay? So what happens in this example if neither one of you is willing to budge on price? Well, there's no deal. Nothing happens. There's no transaction. In other words, the market for this car doesn't move. You're stuck on only wanting to pay 19. He's wanting to only sell it for 20. So no transaction occurs. But what if, in this case, you really want the car? What if you don't want to miss out on getting this car? You don't want someone to come in and take it. In that case, you as the buyer has to become more aggressive. Okay, you have to be willing to pay up to his $20,000 asking price. So he's asking 20, you were offering 19, you have to be willing to pay up to 20. You have to become more aggressive if you really want to buy that car. Okay? Now, on the flip side, let's say that he really wants to sell that car. Maybe he's worried there's another buyer, that there's not going to be another buyer, or that a better price won't come along. In that case, he can't just wait for his $20K price to be hit. He has to become more aggressive in this case. So using the same idea, he wanted to sell it for 20, but he had to become more aggressive and accept your offer of 19. So he comes down to 19. In other words, in this case, the seller, Bob, is more aggressive, and a transaction occurs at 19,000. Okay? So the market went up when you, as the buyer, were more aggressive. The market for this car went down when Bob, as the seller, was more aggressive. Okay? And so the same process is happening literally hundreds of times per second in the markets, but the same principle applies. If collectively buyers are more aggressive than sellers, then price is going to go up. Okay? If collectively their sellers are more aggressive than buyers, price is going to go down. It's really that simple. Okay? Now, while that is simple, the question becomes, how do you make sense of what's going on in real time? And that's actually not that easy. With the sheer amount of transactions that take place in the markets today, you can't really do it with the naked eye, so to speak. You need a tool. You can't just look at time and sales and see what's going on. You need a tool that's going to tell you which side is more aggressive, because again, when buyers are more aggressive, the market goes up, and when sellers are more aggressive, the market goes down. And so having that type of a tool is relatively rare in itself. Most software and most tools don't offer that. It does exist, but it's pretty rare. But what we've done is kind of take it to the next level, and that's what we call our relative aggression bars. Okay, the question that we want to ask is, how strong are the aggressors? Okay, just how strong are either the buyers or sellers? If you have that information in relative terms, then you can filter out the information that matters. In other words, the information that can help you make sense of the market in real time. You can filter that out from the information that doesn't really matter, the information that's just, you could call it noise, so to speak. Okay? And so to do that, again, we have what we call relative aggression bars, and there's 3 levels of both buying and selling aggression. We've got the light green color here, which is a level 1 positive aggression, and that's telling you there's moderate buying aggression, and obviously any of these colors can be changed. You've got the level 2 positive aggression, which is telling you that there's strong buying aggression. Then you've got level 3, which is pretty rare, but when it happens, it's telling you there's extreme buying aggression. Because again, it's not just important to know if their buyers are more aggressive than sellers, or if sellers are more aggressive than buyers. You also need to know on relative terms, so you can make sense of what really matters and what doesn't matter. Okay, same thing with the sellers. You've got the level 1, which is moderate selling, level 2, which is strong selling, level 3, which is extreme selling. Okay. So with that, the question then becomes, how do you use the relative aggression bars? And really the options are pretty much endless, but I just want to hit on a few key points. And essentially the idea is you get yourself into more high edge trades if you know which side is more in control. You can stay out of more losing trades or low edge trades. You can hold your winning trades longer, because if you get into it, let's say you get into a long, you basically want to try to hold that trade until you see selling aggression coming into the market. Or let's say you're long and the market's moving against you. If you see that strong selling starting to come in, you bail on that trade earlier. You get out earlier. The other idea that it's kind of the first technique that we teach is what we call the market roadmap. And really it's a pretty amazing indication of the likely short-term market direction, depending on when you get especially a level 2 or a level 3 buying or selling aggression bar. Do we have follow-through? In other words, does the market continue in that direction within a couple bars, or do we have rejection? In other words, does the market go the other way within a bar or two? Just that information on its own is giving you a very high probability idea of the short-term market direction. And really that's what it's all about. Better information, which leads you to better decisions, which leads you to better results. And that's the whole key behind this idea of relative aggression bars. And I wanted to throw this review in here real quick, because it just speaks directly to this idea of relative aggression bars. This user basically, what he finds most useful about this is the aggression bars. He's completely discarded his other technical indicators, that sort of thing, that basically are, most technical indicators are lacking by definition. The logic makes sense. Finally feels like he's reading the market, reading the signals the market's giving, making sense of the market. And that's the whole point. I'm not going to take a long time with that. But I want to also, when we're talking about these relative aggression bars, that's just one of the components of this software tool. It also includes, among other things, real-time support resistance zones, real-time directional filter, real-time deceleration, other features as well, high velocity moves, what we call that. The idea, and I'm not going to get into this in this video, is that you take all of this evidence that the software is giving you to make better sense of the market, and when you have several pieces of evidence that fall in line together, you've got a very high probability opportunity. And so, what I would recommend for now is to there's a ton of videos on the site. Check out the video, how this works. There's a lot of examples. You'll see examples on the website of all the different features of the software, examples from real-time trading and so forth. So I recommend that if this is intriguing to you, certainly check out the website with other examples. And by all means, if you have any questions, do not hesitate to call us at 919-443-2423 or email us at info@daytradethemarkets, and we will get back to you very shortly. Okay, so just wanted to kind of give that review of the idea of aggression, kind of in layman's terms. Hopefully that makes sense. And if you have other questions, do not hesitate. Let us know. All right, talk to you soon.